the banks are in better shape than they were in 08, 09. They have higher capital because they were forced to raise more capital over the last decade or two. They went from having, call it 15 times leverage to having, say, 10 or 12 times leverage on the balance sheet. There could be a situation where you do have cascading losses and then people pull back on lending. That further hurts values. Now, the Fed can help by lowering rates if they have to. There are some similarities with commercial real estate and the mortgage issues that banks had on their balance sheets back then. As far as hedges are concerned, luckily right now, people aren't really paying attention. So if you want to go out and put hedges on, it's relatively cheap to do so. The VIX is still relatively low. You could put on index hedges. You could buy put options or put spreads. Again, you could avoid the banking sector altogether. The bigger banks are in much better shape this time around. They don't have quite as much real estate exposure as a percentage of their total assets. I don't know that betting against the big banks is really what you'd want to do here, but maybe a short position against regional banks or small cap indices that have a lot of smaller banking components to them, that would be another option.